The Federal Reserve's reign is coming to an end. A high excess hot take. Welcome back to High Excess. Today, we dive into a topic of immense significance that's been buzzing in financial circles and beyond. Brace yourselves as we explore the captivating landscape of the United States financial system and why some experts believe that a monumental shift is on the horizon. Over the decades, the Federal Reserve has held an iron grip on the nation's economy, steering it through recessions, inflation, and financial crisis. But is its reign as we know it really coming to an end? In this episode, we'll unravel the intricate web of factors, theories, and trends that suggest a potential sea change in the way our monetary system operates. So, fasten your seatbelts as we embark on this thought provoking exploration. Don't forget to hit that subscribe button and ring the notification bell to stay updated with our thought provoking content. Let's delve into the intriguing world of finance and discover why some believe that the Federal Reserve's reign is indeed coming to an end. The changing economic environment. Ladies and gentlemen, welcome to a pivotal moment in the economic history of the United States. As we embark on this journey of exploration, we find ourselves at the dawn of a new economic era, one that promises to reshape the very landscape of finance and commerce in this nation. In recent times, the decisions emanating from the hallowed halls of the Federal Reserve have been nothing short of seismic. We've witnessed a rapid increase in the federal funds rate, a crucial policy tool wielded by the Fed to manage the nation's economic health. This rate hike cycle has been nothing short of relentless, and it's sending shockwaves throughout not only Wall Street but also impacting your personal finances in ways you might not have anticipated. The speed at which this rate hike cycle is unfolding cannot be overstated. It's like a whirlwind tearing through the financial markets, leaving no stone unturned. Each decision by the Federal Reserve carries profound consequences that ripple through the economy, affecting everything from the interest rates on your loan to the returns on your investments. For those of you who closely follow economic developments, you'll know that every incremental change in the federal funds rate has a domino effect. It impacts mortgage rates, credit card interest, and the cost of borrowing for businesses, to just name a few examples. But what's even more astonishing is the effect it has on Wall Street. The stock market, once seemingly invincible, is experiencing tremors as investors grapple with the implications of a rapidly changing interest rate environment. In the realm of personal finance, many are re-evaluating their strategies, asking tough questions about how to navigate this turbulent terrain. What should you do with your investments? How will this affect your savings? Is now the right time to buy that house you've been eyeing? These are the questions we'll be tackling head on as we dive deeper into this evolving economic landscape, the rapid rate increases and their implications. Now, let's dive deeper into the whirlwind of rapid rate increases and the profound implications they hold for our economic landscape. Why, you might ask, did these rate hikes happen so swiftly? Well, one reason is the Federal Reserve's concern about inflation. With prices rising at an alarming rate, they had to act decisively to curb the threat of runaway inflation. This sense of urgency led to a series of interest rate hikes that happened faster than many could anticipate. However, while these rate hikes might seem like a necessary remedy for inflation, they come with a set of risks and consequences. One major concern is the potential for asset value declines. When interest rates rise swiftly, it can send shockwaves through the financial markets. The value of stocks and bonds can take a hit, and real estate markets may see cooling trends. This can be a tough pill to swallow, especially for those heavily invested in these markets. To put it in simple terms, it's akin to taking a drink at a party and then experiencing a hangover the next day. The initial buzz of lower interest rates was enjoyable, fueling borrowing and spending. However, the rapid rate increases are the hangover, a painful reminder that the party can't go on forever. For homeowners, rising interest rates mean higher mortgage payments, potentially affecting their ability to make ends meet. Investors, too, are feeling the heat, with their portfolios suddenly in a state of flux. The stock market, which has been a historic bull run, is suddenly grappling with uncertainty, leading to volatile swings in prices. But it's not all doom and gloom. As we'll explore in the upcoming segments, there are strategies and opportunities that can help you navigate these challenging times. It's crucial to stay informed and make well informed financial decisions, especially in an environment as dynamic as this one. The unusual era of zero interest rates. In the realm of finance, there are eras that leave an indelible mark on our economic memory. One such era is the prolonged period of near zero interest rates that the United States experienced, spanning approximately 15 years. This era was marked by a financial phenomenon known as the zero lower bound. During this extraordinary time, the Federal Reserve deployed a strategy of keeping interest rates exceptionally low to stimulate economic activity and combat the lingering effects of the Great Recession. It was a strategy born out of necessity, a response to an economic crisis that threatened to send shockwaves through the global financial system. But what exactly is the zero lower bound? It's the point at which interest rates are so close to zero that central banks find themselves with limited room to maneuver. When rates are already at or near zero, conventional monetary policy tools like further interest rate cuts lose their effectiveness. This prompted central banks, including the Federal Reserve, to get creative in their efforts to stabilize the economy. Low interest rates have a powerful impact on various facets of the economy. They make borrowing cheaper, encouraging businesses to invest and expand. Consumers are enticed to spend, and home buyers find mortgage rates incredibly attractive. In essence, low rates serves as a catalyst for economic growth. However, the story doesn't end there. The effects of near zero interest rates ripple through the financial markets. Stock prices surged as investors sought higher returns in riskier assets. Bonds yielded less, prompting investors to look elsewhere for income. Real estate markets, too, experienced a boom driven by low mortgage rates. But as the saying goes, there's no such thing as a free lunch. The prolonged era of ultra low rates also raised concerns about asset bubbles and income inequality. It created an environment where risk taking was rewarded, sometimes excessively, and savers struggled to find meaningful returns on their investments. Effects of low interest rates on inflation, jobs, and income inequality. The Federal Reserve wields a mighty sword in its role as the guardian of the U.S. economy, and one of its most potent weapons is interest rates. In the previous segments, we explored the era of near zero interest rates and its impact on various asset classes. Now, let's dive into how these low rates influence critical aspects of our economy: inflation, job prospects, and income inequality. Low interest rates can be a double edged sword when it comes to inflation. On one hand, they can stimulate spending, boosting demands for goods and services, which in turn can lead to rising prices. However, during the era of ultra low rates, inflation didn't always respond as expected. This phenomenon puzzled economists and policymakers, sparking debates about whether the traditional relationship between rates and inflation had evolved. When it comes to jobs, the Federal Reserve's ability to control the economy through changes in interest rates is a powerful tool. Lower rates typically encourage borrowing and investment by businesses, which can lead to job creation. However, the impact on employment isn't uniform across all sectors. Some industries benefit more than others, potentially exacerbating income inequality. Speaking of income inequality, low interest rates can play a role here too. While they have the potential to create job opportunities and boost asset prices, they can also contribute to income inequality. Wage growth in lower income sectors may not keep pace with the rising cost of living, and those without significant investments in assets like stocks or real estate may not experience the same benefits. The bottom line is that the Federal Reserve's interest rate decisions have far reaching consequences. They influence not only the financial markets but also the daily lives of Americans. Wealth inequality and low interest rates. One of the most intriguing and often debated aspects of the era of low interest rates is its role in shaping wealth inequality. While these rates have spurred economic growth and investment, they have also contributed to significant disparities in wealth distribution. So, how exactly do low interest rates lead to increased wealth inequality? It's all about the assets. When interest rates are low, the returns on traditional savings accounts, bonds, and other fixed income investments become less attractive. This prompts many investors to turn to riskier assets like stocks and real estate in search of higher returns. The result? A surge in the values of these assets, which primarily benefit those who are already invested in them. Wealthier individuals who tend to have more substantial investments in stocks and real estate see their net worth soar. Meanwhile, those with fewer assets or who aren't able to participate in these markets to the same extent face limited opportunities to grow their wealth. Now, it's important to note that a hot economy, fueled by low interest rates, can have a dual effect on income and wealth inequality. On one hand, a thriving job market can lead to increased income and potentially narrow the income gap. However, the wealth generated through asset appreciation often accumulates among those who are already financially well off. So, while some individuals may experience improved job prospects and income growth, the benefits of rising asset prices tend to be skewed toward those who own substantial portions of these assets. This complex interplay between income and wealth inequality highlights the multifaceted nature of the economic environment we find ourselves in. The shift from zero interest rates. As we've journeyed through the era of near zero interest rates, it's essential to discuss the consequences and challenges that arise when transitioning from this unique period. The shift away from zero interest rates has far reaching implications, particularly for businesses and the broader economy. For many companies, the low interest rate environment was a golden opportunity. They could borrow at historically low costs, enabling expansion, investments, and innovations. However, this environment also led to a surge in corporate debt levels. As the tide begins to turn with rising interest rates, companies, especially those that borrowed extensively, find themselves facing new and daunting challenges. One pressing issue is the risk of corporate defaults. As interest rates increase, the cost of servicing debt rises as well. Companies that relied heavily on cheap debt now face the prospect of higher interest expenses. If their revenues don't grow at a pace that matches these increasing costs, they may find it challenging to meet their debt obligations, potentially leading to defaults. Defaults, in turn, can have a cascading effect. They can disrupt supply chains, lead to job losses, and even impact financial institutions that hold corporate debt. This interconnectedness highlights how changes in interest rates can ripple through the economy, affecting various sectors and stakeholders. Additionally, as companies grapple with higher borrowing costs, they may scale back on investments or hiring, potentially affecting economic growth. This shift underscores the delicate balancing act that central banks like the Federal Reserve must perform as they navigate the transition away from near zero interest rates. Interest rates, risk taking, and the banking sector. Interest rates, set by the Federal Reserve, are like the heartbeat of the financial system, influencing not only the economy but also risk taking behavior across the board. Let's explore how these rates can impact risk and the critical role they play in the stability of the banking sector. When interest rates are low, as we've seen in the era of near zero rates, the cost of borrowing decreases. This creates an environment where individuals and businesses are more inclined to take on additional debt, often at favorable terms. The desire to capitalize on these low rates can lead to increased risk taking, as borrowers might be tempted to leverage themselves more aggressively. However, when the Federal Reserve raises interest rates, the cost of borrowing goes up. This can serve as a reality check, causing borrowers to rethink their risk tolerance and lending institutions to become more cautious. The goal here is to strike a balance between promoting economic growth and preventing excessive risk taking that could lead to financial instability. Now, let's shift our focus on the banking sector. Banks typically have a mix of short-term and long-term assets. When interest rates rise, it can pose challenges for banks with large holdings of long-term assets. These assets, such as mortgages or bonds, may have fixed interest rates, meaning that as rates rise, the value of these assets can decrease. This can impact the bank's profitability and financial stability. Furthermore, in a rising interest rate environment, banks may see a decline in the demand for loans, which can affect their lending business. Additionally, the value of their existing fixed-rate loans may decrease, affecting their balance sheets. In response to these challenges, banks must carefully manage their interest rate risk, striking a delicate balance between their assets and liabilities. The Federal Reserve closely monitors the health of the banking sector and adjusts its monetary policies according to maintain stability. The future of saving and economic dynamics. As we near the conclusion of our journey through the complex world of interest rates, it's essential to consider how individuals, businesses, and our economy as a whole can adapt and thrive in a rising rate environment. For individuals, higher interest rates can be a double-edged sword. On the one hand, they can mean better returns on savings and investments, potentially encouraging more prudent financial habits. As rates increase, individuals may seek out better savings vehicles that offer higher yields, helping them grow their wealth over time. On the other hand, higher rates can make borrowing more expensive, impacting everything from mortgages to credit card debt. So it's crucial for individuals to carefully manage their financial portfolios, striking a balance between savings and debt management. From a broader economic perspective, higher interest rates can have a positive impact on business dynamism and entrepreneurial spirit. When borrowing costs are lower, it might seem like a good time to invest and expand. However, during an era of rising interest rates, businesses must be more strategic and innovative to thrive. This can foster a climate of increased competition, innovation, and efficiency, which can ultimately benefit consumers. Yet, the future is never without uncertainty. As the Federal Reserve continues its rate hike cycle, it may face challenges and difficult decisions. Economic consequences are often subject to debate, and experts may disagree on the best course of action. The potential consequences of these rate increases on various sectors of the economy, from housing to manufacturing, are still unfolding. In the coming years, we'll undoubtedly witness ongoing discussions and debates about the path of interest rates and their impact on our lives. What's clear is that adaptability and informed decision making will be key for individuals, businesses, and policymakers alike. Thank you for joining us on this thought provoking journey through the intricate world of finance and economics. We hope that you've gained valuable insights in the shifting sands of interest rates, wealth, and economic dynamism. At High Access, we're committed to bringing you in depth explorations of the most critical topics that shape our financial future. Whether it's understanding the nuances of monetary policy or navigating the complexities of the stock market, we are here to provide you with the knowledge you need to make informed decisions. To stay updated with our thought provoking content, be sure to subscribe to our channel and hit that notification bell. Your support fuels our passion for uncovering the stories behind the numbers and helping you chart your course in these ever changing times. As we move forward into an uncertain future, remember that knowledge is your most powerful asset. So, continue to stay curious, keep learning, and never stop seeking answers to the questions that drive you. From all of us here at High Access, thank you for being part of our community, and we look forward to exploring the fascinating world of finance with you in the days, months, and years ahead. Until next time, take care and make those financial decisions wisely.